Welcome to Accounting High.
3 buckets, 50, 30, 20.
Right. And it's a very simple, effective system that you can use to scale your business. So once you understand the system, as you grow, you can live and die by this rule and you'll always be profitable. So what we're saying here is if you follow the system, I can guarantee you that you'll always make a 20% net profit in your business on top of your regular wages that you pay yourself.
Check out the Cashflow show. We discuss topics like getting paid on time, profitability, and managing your bottom line, payroll best practices, the best apps to use, and cash flow forecasting tools. So if you're a small business owner, your help's right around the corner. Fret not. Tune in as Scott and Nikole help you reach your goals on the Cashflow show. The Cashflow show. Listen and learn. We'll show you how to pay yourself on what your business earns. With Nikole and OKR.
What up, what up, what up? What's up, Nikole?
Hey, Scott, that song is still such a banger.
It's catchy. So smooth. So today, we're going to bring back the P's. We're talking about profitability. Profitability problems, persistent profitability problems are not something that you should have as a business owner. Is that right, Nikole? Got
That's
any clients
right.
that have consistent cash flow problems?
Yeah, so if you have cash flow problems regularly, that means that you have a profitability problem. Cash flow issues can come and go in a business, but they should be intermittent. They should be temporary. And so if they're happening all the time, then we really need to look closer at your profitability. So today we are going to do a deeper dive into the 50, 30, 20 rule, which I mentioned briefly in our first episode. But this rule,
Have
if
you trademarked that yet?
Not yet. Not yet. I might if it takes off. But yeah, I've spent a lot of time researching different models. I've spent a lot of time obviously working with different businesses in my own business. And one day I came across this like pattern that I noticed and tried to take accounting the way that we've previously accountants have thought about profitability, right, with gross profit margin and net profit margin, and just try to make it a little bit more, tweaked it a little bit to make it a little bit more simple for business owners to understand.
Yeah. Templatize it a little bit or make it so it's a path that is a possible path for them. I mean, a lot of people that are having consistent profitability problems, they're too close to the issue anyway, and they can't see it from this perspective, from the accountant's perspective, or from this idea that it's simple. The way you're looking at it, it's 3 buckets, 50, 30, 20.
Right. And it's a very simple, effective system that you can use to scale your business. So once you understand the system, as you grow, you can live and die by this rule and you'll always be profitable. So what we're saying here is if you follow the system, I can guarantee you that you'll always make a 20% net profit in your business on top of your regular wages that you pay yourself.
Yeah. So if you recall, I'm sure you remember our first episode was COGS, and we talked about this 50, 30, 20 rule. But for our students, for our listeners that haven't heard that episode, you want to give a little recap?
Sure. Yeah. So the number one thing that people mess up when it comes to their financial reporting is not properly identifying COGS, which is short for cost of goods sold, or direct costs. So those three terms will be used interchangeably, and overhead. So COGS versus overhead. So this is foundational for understanding how to scale your business profitably. We first need to be able to identify what expenses and what people go into COGS versus what expenses and what people go into your overhead costs.
So you need to make sure that you're categorizing everything correctly and you're not just dumping everything into COGS or just dumping it into overhead.
That's right. So what I like to do when we have a client that comes to us, a prospect, as part of our sales process, I do a health assessment, financial health assessment. And the very first thing I look at is a summarized profit and loss statement looking back the last 12 months. So if you think of it at the top, I know we're not looking at anything right here. So there'd be 13 columns. Each column is a month for the last 12 months, depending on where you are in the year. And then on the far right would be a total column. And the reason I like to do trailing 12 is because it allows us to account for seasonality, right? Looking at just the current month or year to date doesn't typically tell us anything. And so when we do trailing 12, we can look at seasonality. And then also most of the clients that come to us are not on accrual-based accounting. Accrual-based accounting gives us consistency month over month. But if we're on cash basis or something in between, looking at one month or the other, we might see a lot of variability. So if we can look over that trailing 12, we can begin to see what our total net profit margin is, or we can start to look at those buckets, the 50, 30, 20 buckets, and one, identify immediately if the business is properly categorizing those. So most of the time, the expenses that should be in your 50, your COGS, end up in overhead costs. So immediately I can say, okay, that's an accounting issue that Momentum Accounting can fix, right? But let's say they are properly categorizing between COGS and overhead. Then I'm looking at the percentages. And a lot of the times when I look at the net profit right at the bottom, it's less than 20%. It's 1%, it's 5%, it's negative, it's 10%, right? And so what I can easily do is identify whether the issue is up in COGS or the issue is in overhead, and then talk through with the client, what are the steps that we need to take to correct this so we can get you to that 20% net profit margin. Now, the 50, 30, 20 rule is, what's the word I'm looking for? Not a simple, but like there may be some types of businesses where 50, 30, 20 isn't the exact number, right?
It's a general rule. You're generalizing a lot of things here. And let's get a little specific. If we're having trouble saying some businesses might do this or some might do that, let's get a little more specific and say a service-based business that's primary product is people, right? So we're not dealing with inventory. We're not dealing with actual like inventory methods or cost of goods or things like that, things that could be on the balance sheet and everything. We're just dealing with service-based people. And in this case, most of your COGS is going to be your people costs, right? And maybe there's, like you said earlier, maybe there's some people that could be in overhead, maybe just admin type people, but anybody doing working at like your product, if your product is your people, obviously anybody that's working in operations is going to be in cost of goods. So then we can be more specific and say your costs or your employee costs should be 50% of your revenue, right? And if that's the case, then your pricing really needs to reflect that too. But I think I've gone a little too far or a little too detailed, but if you need to scope back out, let me know.
Yeah, so we can go through an example of a service-based business. So let's just go through, to your point, defining COGS versus overhead. COGS is any people, vendors, costs that go into directly generating revenue. So for a service-based business, the people who are directly working with your clients would be your COGS. And then things like rent, things like your bookkeeper, IT department, sales, marketing, HR, probably the owner's salary, maybe your director of operations, maybe admin staff. All of those are going into your overhead. The way that we want to look at it is you've got your revenue, you've got your COGS, your overhead, and net profit. And those are the four main buckets. Okay, so once we've got the four main buckets. So let's say our revenue is $1 million, right? And we're saying our COGS should be no more than 50% of our revenue. So we start with $1 million. We can spend $500,000 on COGS. Then we've got 30% of that million, so $300,000 that we can include on our own wages, that we can spend on all those other things I was saying, marketing, IT, rent, admin staff, blah, blah, blah. And then that leaves 20% or $200,000 in net profit. So one thing to highlight here is that with a lot of businesses, particularly pass-through entities like S-corps and partnerships, the wages that you pay yourself are discretionary. So there will be certain situations where I'll have a business come to me and the owner's not paying themselves any salary at all. And so in order for this formula to work, we have to normalize our buckets here by imputing some sort of owner wage. So as a rule of thumb, I'll usually use like 1% of revenue. So for example, if you have in this example, $1 million business, $100,000 would be owner wages, and that would be in your 30% bucket, right? And so typically I'll say like 1% with a minimum of 50,000 for the salary for the owner, and then a maximum 250,000 for the salary.
Wouldn't that be 10%? Isn't that 10% of a million?
Oh, that is 10%.
Because 50%, you said 100,000.
Yes, sorry.
It would be 10,000 if it was 1%.
Yeah, that's what I meant. Sorry. Yeah, so typically we want to use 10% of revenue as a rule of thumb. If you're not paying yourself a salary currently and you want to just do this simple math to figure out if your margins are in line, your percentages are in line, then take 10% of your revenue and use that as your salary. So for example,
interesting. We say take 2/3 of profit as a salary.
Well, okay, so let's clarify here, because you're talking about that from reasonable salary, from keeping the IRS compliant. I'm talking about, let's look at our business from a management perspective and think about what it would cost to replace ourselves. And when we're benchmarking ourselves against this 50-30-20 rule, we need a standard way of looking at that. So most business owners are paying themselves somewhere in line that makes sense. But I'm saying, like, for example, I had a client that a partnership, and they're running everything through draws. So when I looked at their P&L, they looked really profitable. They had a 40% net profit margin. They had 3 partners, but there were no wages going through the P&L. So I can't compare that business to another business that is paying them. The owners are running salary through the P&L. So in order to get us all on the same page here, there has to be some owner comp run through the profit and loss statement. And so that's why, as a rule of thumb, if you're not, or you're underpaying yourself, use 10% of revenue, but don't go below 50,000 and don't go above 250,000. Make sense?
Okay.
It's a little difficult to verbalize when you're not looking at the numbers in front of you.
Well, it makes sense, because essentially what you're doing here is another categorization tool, because it doesn't change what they're actually taking home in this case. If it's a bunch of partners that are taking a draw, this doesn't change it, but it categorizes it on the profit and loss, so you can properly identify what the problems are in the business. Profitability problems.
Right, exactly. And also, to my point about having partners, when you have multiple owners, profitability becomes a little more challenging when you're smaller, because you have multiple people that are highly compensated. That's why typically in partnerships for service-based businesses, a lot of the partners are doing billable work. They're bringing in revenue, because otherwise you would just go hire an employee, because they'd be less expensive than a partner. Partnership models are a little bit different. So really, in a partnership model, you need like $1 million in revenue per partner to get your margins in line.
So any service-based partnerships you're looking at, for any of them, if they're over $1 million, this is a way to work. But if they're just starting out, one partner may not even need to take anything home, and one of them is relying on it, and they're just building the business. I mean, there's all different kinds of scenarios, but these are more established, larger partnerships. Okay, cool.
Right. That's one thing I see struggle for smaller partnerships under $1 million, is that they struggle to make the amount of money that they want to make, because there's just not enough revenue at that small size. But the idea of partnering with someone, right, is that you can grow the business much faster. So you can get your business to $2 million together faster than you would separately.
But you also don't want to cannibalize all the profit. Yeah, you don't want the owners or the partners to cannibalize all the profit too, because that would definitely play into your 50-30-20 if you had partners taking too much out of the business because they needed it. So we're talking a fair salary.
So you decide on salary based on, you might have one partner that only works part-time or doesn't do anything in the business, and they're not taking a salary. And then one partner who's 100% active in the business, and they're taking a salary. And the other partner is just taking distributions. So remember, as the owner of a business, you are the CEO and you get a salary, and you're the owner and you get distributions.
One important thing to note then is, all of this is because we need to show the owner taking a fair salary to show what it would cost to replace them. So this way, your actual profitability is intact. If they were to exit, or if they were to replace themselves, how much is it going to cost to pay somebody to do what they're doing? And your business, profitability and your financials should reflect that too, just so you see the health, making sure that you can properly identify the problem. So all of this knowledge session that we've been talking about today, the 50, 30, 20, is to help properly scope in and identify what are your profitability problems, because they could be many. It could be many different things, but when you have everything properly categorized and you're looking at clean financials over that 12-month period, you can identify where it's out of whack. If their COGS are 60, 70% most months, well, there you go. Now let's dive a little bit deeper into COGS. And if their ops is, 40%, 50%, then to dig in there. And that's your profitability problems. So at least where to look with these buckets, right?
Yeah, that's exactly right. And so one thing I like to do is, as soon as I get those numbers, the 3 percentages, when I run this on a prospect, I then show them, okay, so your numbers are off, right? Your net profit is not as much as you would like it to be. And then if we look at your COGS as a percentage and your overhead as a percentage, what are those numbers and where are they off? And then I show them, what is your business? I show them 2 scenarios. So what does a business look like if you right-size your cost to align with your revenue? So if you have $1 million in revenue and your COGS are $600,000.
What does right size mean for the listeners?
So right size basically
right size.
Right size. So again, if your business has $1 million in revenue and your 50-30 is off, so let's say you're 50-60, your COGS are 60% of your revenue, so they're 600,000, then that means you need to reduce your COGS by $100,000. So then the next question is, can you actually deliver $1 million of revenue if you cut your COGS $100,000? And then if the answer is yes, then
or you need to increase your revenue, right?
Right. So then that's scenario number 2. So scenario number 1, we're aligning our costs with our revenue. Scenario number 2, we're saying, okay, well, let's say your COGS stays the same. Here's what your overhead should be. Then what revenue do we need to get to? What's our target now to align our COGS overhead with our revenue? And so then the next question is, with your existing team and resources, can you manage that much revenue? If the answer is yes, then you have a revenue problem, right? You have a marketing problem. Go sell more, right? If the answer is no, and if
you have too much capacity.
Right, you have too much capacity. And that happens, right? That's not a profitability problem, that's a revenue problem. But if you show them, or if we look and we see, this is what your revenue needs to be to support these costs, and you have to go incur more costs to generate that revenue, and you're still going to be off, right? Your numbers are still going to be off as you grow, then we need to make some changes. And that's what we'll get into, the 4 areas to look at when our 50 is off and our 50, 30, 20 is where we'll start.
So we have some insider tips on different directions you can go when these profitability problems happen. So we've diagnosed it and we've looked at it, and we're using the 50, 30, 20 rule to identify which buckets are off. We know if your profit is less than 20, that's a problem. If your profit is more than 20, is that a problem?
It could be. It depends.
It could be.
Right. Yeah, you can definitely
could have people that are almost ready to quit because they're overworked. Right?
Yep,
you could have a situation where you may end up having another problem because of that. So when you look at and this is something I learned from another one of our colleagues, and he said if his profit's ever too high, he's looking to hire immediately because he knows that his team's feeling that.
Yep.
When the profit's too high, all things being equal, if things are dialed in and you fit that, if your profit is too high. That was my one question, is what happens if your profit's too high?
Yeah.
Because if your costs are too high and everything else. Yeah.
I think the word I was looking for was antidotal, maybe. So the 20%, you could say, hey, I want to be a slow growing, like personally in my business, I want my 20 to be 30 and I'm slow growing. So I care more about profitability than I do speed of growth. Now, our colleague, who I know who you're talking about, he's like, grow, top line, grow as fast as possible. So he's always putting fuel on the fire. So he's willing to take a lower profit margin in order to grow faster.
Oh, no, I'm talking about a different colleague. but I know which one you're talking about now too. So
I think I know who you're talking about.
so yeah, okay, all right. We could mention them too, but this is an accounting show. So if we're looking at this correctly, we're looking at classification problems where things might be classified wrong to show your actual costs and to show your actual profitability. And after you've gone and diagnosed everything, classified all of it, you've got
Yep.
your buckets in there. Now we've got 4 potential things to do to fix this next, right?
Yes, and
So
this
we've-
is
we've
4
got it all
potential
laid out.
things.
Here's our 4.
So first we're going to look at just your 50, just your COGS, and we're going to solve that problem first. So I've got 4 solutions for you. Okay. And then we'll get into
4 solutions. Our COGS are way over 50%. We've just looked at it and now we're blown out of the water.
So what's the so what behind that? So we've got 4 options. The first one is the easiest to do, and it's what most consultants will tell you to do. And that's to increase your prices, because then you can have the same amount of costs, increase your revenue. But then the question becomes, will the market actually pay this price, right? Will clients churn if I raise the price? Will people stop buying my product? Will people stop buying my service? We're always trying to align market demand with our pricing. So things that we can do to get people to pay a higher price are going to be to attract clients to our brand, right? So if we're doing things on social media and marketing, we've got people that are already know and trust our brand. They're more willing to pay a higher price. Maybe we think about niching. We also might look and see if there are any services or products that are more profitable than others. So maybe we try to sell more of those and less of the less profitable ones. But end all goal be here is to just overall increase our prices.
Yeah. And I've tried to do this. I've tried to increase prices to the point where the market would not pay them. So I've figured out what our limits are at our business just by doing just that, is raising prices until people wouldn't pay it. Then the next step would be to go a little bit further and niche and all that, which we haven't done, which is why I've seen top line limits on our pricing.
Yeah, same. And then people can be priced differently too, and depending on how big their problems are. Pricing's, there's a lot of things you can do with pricing, but
we can have a whole episode on pricing.
That's right. Okay. So let's get into number 2. So number 2, the opposite of increasing prices, well, we can reduce our costs to deliver our service or our unit costs of our product. So, something that we did at Momentum.
This one's my favorite.
This one's one of the best levers you can pull, especially if you're having downward pricing pressure on your industry, which is what we're experiencing in the bookkeeping and accounting space right now, because there's more people entering the market. So what I was feeling that pressure at Momentum. And so what we ended up doing was we started offshoring. So we started hiring people in countries where their labor is less expensive. And that's allowed us to maintain or even improve our margins and be competitive with our pricing.
Yes, we have done that as well. And you can see a bit, and anything like, mostly when it comes to reducing your costs, a lot of those, or a lot of your COGS, a lot of those, you have people you've been working with forever. You've got your employees, so you have to look at alternative methods to do things too. And reducing your costs might mean freeing up capacity so your team could do more, which might mean there's other things. That's leading us to the next one, I think, is different ways, faster ways of doing things too. New technology, new tools.
Staying on number 2, aside from reducing our labor cost, we can also, if you have vendors that you pay, right, finding less expensive vendors, maybe getting bulk prices. If you're buying supplies, if you're selling something, can you recover shipping costs by passing it on to the customer? The big point of all of this is once you're problem aware, then you'll actually take action. Because if you don't have the data, you're not ever going to go out and do these things. You're just going to keep humming along. But as soon as you see the numbers in front of you, you're like, shoot, I've got 10% that I have to reduce my direct costs. You're going to start looking under the couch, finding pennies, figuring out ways to cut costs.
Yes, you don't want to be in a desperation mode there, but
no,
just a look at that, especially with an accountant. I mean, accountants are very good at saving money. So take a look at some of those expenses. Get new contracts for insurance or things. That could be a big suck too. Insurance costs. So Let's move on to the third one. That's the one I was interested in because that's fun. There's a fun ways to look at new ways of doing things too.
Yeah, I have some good examples with this one. So the third one is to deliver faster or complete whatever you're selling faster.
Can you explain to what does faster do? What is faster going to leave you with? If you do things faster, what do you have more of?
I'll give you some examples. So one might be our sales cycle time, right? So if we have a really long sales cycle, we're onboarding clients slower. So if we onboard a client today, we're getting that revenue right away versus waiting for a month or two to onboard that client. So that would be an example in our type of business. Another example would be like a dry cleaning company. So there's a woman that used to own a dry cleaning company in my EO group, and she was talking about how they would charge their credit card when the customer came to pick up clothes. And what would happen is they'd have all these clothes sitting on the rack and the customer wouldn't come pick them up. And so what they did was they actually had a woman that was, when they figured that out, they couldn't charge the credit card until the customer came and picked up the clothes. They did a big push to have someone on their team go out and reach out to the customer to get them to come pick up their clothes, right? Or they would go start delivering the clothes to the customer. They started doing delivery so that they could recognize that revenue. Another example would be if you ship out inventory. So we can't recognize revenue until we've actually completed the service or shipped goods to our customer, right? So inventory type businesses, you don't recognize revenue until you ship the goods. So we want to we don't want to be sitting on inventory. We want to ship it out as soon as possible. That's going to drive revenue. Consulting company, let's say you have projects and you bill by completion of the project, so work in progress. We want to complete the job as quickly as possible so we can invoice for that work that we've done. And then another area of improvement is our sales cycle time. So if we have really long sales cycle, it's taking us longer to get revenue in the door. We want to shorten that cycle so we can get customers in the door faster.
Faster, more speed.
Speed. Okay. And then the last one, I think both of you and I can resonate with this one a lot because it definitely applies to our business, is doing more with less or being more efficient. So for example, you might have employees who are doing a lot of non-billable time, or they're sitting around not doing client work. And so we want those people who are generating revenue to be spending most of their time, 80% or more of their time, on client work. Another example would be using technology to be more efficient, right? So that our team can do more without increasing costs. If you're a restaurant, you might be turning tables over faster or fitting more tables into your restaurant so that you can service more people with the same, overhead costs.
So doing more with less would be more capacity, right?
Mm-hmm.
It would give you more capacity to do that. So when you say do more, like your employees, 80% of their time needs to be spent doing client work, right?
If they're
How does
billable,
that fit into
yeah.
the 50%, the 50, if they're billable, right? And
Right.
how do you know? How do you
So-
know 80% of their time is being spent on client work?
Well, I guess you'd have to track time, but you wouldn't have to track time if your numbers are in that 50% or less, then maybe you don't have to track time you're on. But if they are going below, then you may want to figure out why. So that might be a time where you go track time. Generally, as a business in a whole, so between your billable and non-billable staff, you want a total for the company to be billing 60% of all time to billable work. And then your employees who are directly working with clients, you want at least 80% of their time on client work.
So this is all related to COGS, right?
This is all related to COGS. Yeah. So hopefully.
So this is all related to 50%.
So hopefully that once you go through that exercise, we've fixed our 50%. We're good on the 50%.
What if overhead is too high then?
Okay. So
this is all addressing the COGS, right? What happens if overhead is too high?
Right. And overhead, I would say that 95% of the time, the problem is in COGS. The other 5% of the time, it might be in overhead. And this can happen as businesses grow and they start to layer on management teams and they'll get bloated on the management side. So they've got too many partners or they've got too many high cost people that aren't doing revenue producing work. That can definitely happen. And so knowing your budget, trying to keep within that 30% will help you make smarter hiring decisions. Because I know as a business owner, it's really tempting. When I was hiring for a new COO, there were people I talked to who wanted a much higher salary. And it's like tempting, right? Because you think this person can come do things for your business. But I always went back to like, that's too high of a salary for our business to sustain that at the size that we're at. So I need to use that as like the 30% as like a guiding light for me to make decisions on who I'm going to hire. And then I also think about that when I'm spending money on marketing. I have a certain amount that I allocate each month to marketing and then other consulting. And I try not to go above that 30% so that I'm allocating my resources properly. Another example would be like restaurants. I'm on restaurants today for some reason. They basically live and die from their rent cost. So if you ever see a restaurant that goes out of business, it's typically because their landlord renewed their lease and bumped up their rent. And like typically restaurants, they're maxed out on what they can bring in terms of revenue in one single space. And so their profitability is really, really dependent on their rent. So in that case, the restaurant unfortunately has to move out of that space and find a less expensive location.
Yeah, there's a lot of reasons why restaurants go out, but that's definitely a big one. Those overhead costs. Rent is one of the biggest for most people that have, brick and mortar structures to deal with. Rent is not considered COGS though. So that's going to be the bulk of most people's overhead cost. It's a fixed.
Yeah, unless you're a manufacturing company, you may have some sort of, allocation for COGS. But for the most part, rent is not. And I know you used to have an office, right, before COVID, and then you got rid of it. Not only did you get rid of it, not only did you get rid of rent, you also you didn't need like an office manager, right? Greeting people at the door when they came in, dealing with paper.
There was so much. So the office, there was a person that was eliminated. There was the physical rent that was eliminated. There was also all the extra stuff that goes with an office that you don't really think of associated with rent, but it all is. All those utilities, a lot of the supplies, a lot of the extra office related stuff that you always just know you have to deal with, is all that's gone. That was a big shift in our costs. I guess our overhead went down in that whole scenario. We practically have no overhead.
When you did that, did you replace any of that overhead with any other costs? Like for us, we don't have rent we don't have a physical location, but once a year we try to get together in person. That ends up being, $10,000 trip. So I'm replacing rent basically with a lot of software that we use because we're all 100% online, and then also that in-person trip. So I'm still, I would say, net saving money by not having an office, but I am using some of that cost savings in other ways.
Yeah, we go on some trips. Usually it's ZeroCon or something around that. And I guess we haven't done that in a little while. So I'm seeing more increased savings than I am replacing it with other things. I mean, I think everybody had salary increases after we didn't have rent. So I kind of absorbed some of it too. Once we saved all that money, I was like, well, I don't want to just sit on this myself. I'll just increase everybody's salary, and then it was gone.
Okay.
So maybe we don't do that in the form of retreats. It just did that in the form of, okay, well, I just kind of erased the savings.
Everybody gets a little more moolah.
Yeah.
Okay. So let's summarize then. So point number 1 is cash flow problems should be intermittent. If you have cash flow problems regularly, you have a profitability problem. If you have a profitability problem, make sure you're categorizing your COGS and your overhead properly, and then look at, as a percentage of revenue, how much is in COGS, how much is in overhead, and how much is in your net profit. Aim for COGS to be no more than 50% of your revenue. Aim for overhead to be no more than 30% of your revenue, and you'll be left with a 20% net profit. Caveat here that you should have owner's comp somewhere in there. When you first start out your business, it may be in the 50 in the COGS when you're doing the client work. And then as you move out of the client work, you're going to move into overhead. If your COGS are off, we gave you 4 areas to go look at: increasing prices, reducing costs to deliver, finishing faster, or doing more with less. And then once you fix your COGS profitability, or your COGS problem, and if you have if your overhead is too high, then start looking at the expenses in your overhead costs and setting budgets that align with your 30%. And then you should be left with a 30% net profit plus your salary. And yeah, I think that's it. Easy, right?
Yeah. Oh, it's never easy. It's never easy for somebody that's in the middle of it. They didn't see any of these things. You just highlighted a ton of things that they need to go work on, and that's not going to be easy either. So I hope you listeners got something out of this and found a few pieces or a few threads to start pulling in your business and start identifying some of these problems and ways to fix them too. Because you could keep pulling that thread forever, and then you'll see that there's another mess on the other end of it too, potentially. Fix one thing, and then you got to fix the next thing. All right, cool. So our listeners too, if you made it this far, please go in and leave us a review. We would love that. We'll read it on air. Go into Apple Podcast, go to a little podcast player, type in your review, all the things that you like about listening to the show. Maybe if you're in Spotify, tap the little star button there. I think that gives us a star. Send us a note on LinkedIn. You can reach Nikole Mackenzie. That's Nikole with a K, Nikole. And Scotty, there's a little OKR in there too. But yeah, we're both on LinkedIn.
And then if you want to find out more about Momentum Accounting and our services, you can go to momentumaccounting.com. And then Scott, I know you've got links to Accounting High. Do you want to promote Accounting High or Padgett?
Well, if they need tax-related work, Padgett NC.com. That's where they should go. We are taking on clients.
And if you're an accountant listening to this, go to accountinghigh.com.
Yeah, go check out Accounting High. All right. Peace out, homies.
Yeah. So you're drowning in cash flow issues. You run a business, but feel like it's running you. Customers won't pay, but you got bills due. It appears you won't have enough for payroll coming up soon. It seems like you're running nowhere fast. You work hard, but never able to withdraw cash from the business. You get more customers, hire more employees, but still take home hardly anything. You feel like you're on a hamster wheel, frustrated cause the battle's always uphill. Even though you got a bookkeeper on your team, they send you reports, but you don't really know what they mean. Your CPA doesn't understand a thing about your business, at least that's how it seems. But if you want to get above water and grow, check out the Cashflow Show. This is the Cashflow Show, where we help the small business gain momentum and become profitable. This is the Cashflow Show. Listen and learn. We'll show you how to pay yourself on what your business earns. Cashflow Show. Topics like getting paid on time, profitability, and managing your bottom line, payroll best practices, the best apps to use, and cash flow forecasting tools. So if you're a small business owner, your help's right around the corner. Fret not. Tune in as Scott and Nikole help you reach your goals on the Cashflow Show. The Cashflow Show, where we help the small business gain momentum and become profitable. This is the Cashflow Show. Listen and learn. We'll show you how to pay yourself on what your business earns. Cashflow Show. Our advice will take you far. Cashflow Show. Tune in with Nikole and OKR.